Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Pereira. Worried about an economic slowdown, Finance Minister Arun Jaitley is in a meeting with top officials from his ministry to discuss intervention to put the economy back on a high growth path. Key indicators such as the gross domestic product and industrial production continue to plummet, and a widening current account deficit has added to the worries. Earlier, Prime Minister Narendra Modi was scheduled to review the economy along with Jaitley, but media reports said that he will not attend today's key meet. Today's interaction is likely to focus broadly on what ails the economy and the fiscal space available with the government. On this edition of The Big Picture, we will analyze how can India revive its growth thrust. Joining me on the program today are Ajay Shankar, former Secretary, Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. Professor Manoj, Panda, Director, Institute of Economic Growth and member, National Statistical Commission, and N.R. Bhanumurthy, Professor, National Institute of Public Finance and Policy. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Shankar, I'd like to begin with you. Where do you think our economy is today? Does it need some kind of corrective measures?
It does. And the problems have been building up over time. And now I hope that the situation will get the serious attention it deserves and some course correction would be undertaken. Because if you look at the trends over the last few years, there has been a decline in capital investment. So it's a continuous steady decline, and private investment has not revived for years, and the IIP numbers have remained disappointing for some years. So on three fronts you've had a trend which is worrying, and then it gets reflected in terms of lower exports and reduced bank credit, etc., etc. So I think some major course correction is required to see how we could revive private investment and how we could get IIP numbers to move up.
Indeed.
And business as usual or more of the same would not work in my view.
Okay, business as usual will not work. Professor Bhanumurthy, is it time to think out of the box and come up with something new then?
Well, I think I completely agree with Dr. Shankar in terms of the kind of urgency that we need to show on reviving the overall growth prospects. But in any case, one needs to understand why this slowdown. I think that's very important before we talk about what kind of cure that we would like to bring in.
Post demonetization and GST, would you think that this was this was what was going to happen on expected lines?
I think these are the two major policy intervention, back-to-back intervention. It looks like the economy could not take.
So nothing extraordinary has happened then?
I don't think there's a very serious thing that happened, except because of the major disruption that we have seen in the post demonetization as well as the implementation of GST. Apart from this, if you look at other policy changes that the government has brought in, whatever doctor has prescribed, on May 2014, the analysts, economists, I think the government has done most of the things that the market was demanding. They have done many things, including the GST, and the only thing that they have not really understood was the kind of disruptions that the GST would bring in terms of the demand. So right now it has become more, the decline in the demand has become much more persistent, and added to that, the demonetization has worsened the whole situation. So in that sense, I think we need to have policy measures that can revive the demand, and maybe we can discuss what kind of measure that we really look for. And I think there is a need for, certainly as Mr. Shankar said, there is a definite need for course correction if you want to revive your overall growth prospects.
Sure. Let me go to Professor Manoj Panda now. Professor Panda, what else do you think ails the Indian economy as it stands today?
I think apart from the investment and the industrial production, we also need to look at the trade side. The exports decline. It has been declining continuously except for last 1 or 2 months. And we need, that will be a major source of demand, that the economy depends on in the during the phase when we had the high growth, the exports were increasing at 20-25% per year, and now that has slowed down. At times it became negative, and I feel that that will be a major source of demand in reviving the economy.
Sure. You know, go ahead. We can hear you. Yeah.
The government can do. Yeah. No, I was just telling that. The signals on the price front, that is the exchange rate for the trade sectors, are critical, and we must correct the appreciation of the rupee to somewhere around, say, if not where it was 2 years ago, at least where it was about 1 year ago. Without that, without a proper pricing mechanism, exporters, even if you have other measures, exporters possibly do not feel that they have sufficient profit in this sector to export. Of course, beyond the exchange rate, we also have to look into specific countries, particularly the East Asia, China and other East Asian countries, market focus and also sectoral focus. Certain sectors where we have more competitive advantage, we must focus on that.
Sure. Clearly, the Prime Minister and the Finance Minister have realized that something's up as far as the economy is concerned. You said that, corrective measures need to be taken. Clearly, the government is working on that as well. What do you think should be some of the immediate steps that need to be taken? And would you say that current account deficit is a problem at the moment, or it's something that can be neglected for the time being?
Now, I would say that you need some measures which are immediate in nature and other measures which will, if initiated now, have an impact over time. Now, the most critical issue has been referred to by the last panelist, which is the exchange rate. Unfortunately, in India, the exchange rate doesn't get the attention it deserves. When industry wants to attract attention of government, it talks of interest rates. The fact of the matter is that exchange rate is a very powerful instrument which can work both ways. Now, the fact of the matter is that the Indian currency has been experiencing steady appreciation of the real exchange rate, and the real exchange rate is the differential between our inflation rates and that of our trading partners. Now, this has been going on undisturbed for about 8 years. Now, if 8 years you allow the real exchange rate to appreciate, then it doesn't hit exporters alone. It hits domestic manufacturing, because we are a free open market economy. So imports become cheaper, and so the domestic producer gets wiped out or loses market share. So the exchange rate, in my view, is the most powerful instrument which the government can use right now to get some spurt in domestic production, value addition, demand. It has been a standard prescription of the IMF World Bank packages for a whole generation. And for some strange reason, we have not seen the value of the exchange rate as a driver of growth and manufacturing and value addition. If you look at all the East Asian success stories, they consistently followed a policy of keeping the currency artificially depreciated. Now, we have followed a policy of actually appreciating the currency when we want high growth. So this is, in my view, the most important silver bullet which could be attempted right now.
Okay, you're calling it a silver bullet, yes. And it could be a game changer is what you're suggesting at this point in time. Any other such measures that we can take, Professor Bhanumurthy?
Well, I slightly disagree with both the panelists in terms of exchange rate being used as a policy measure. In a sense, what you're saying is that you need to manipulate the exchange rate as a policy measure to prop up exports. If you look at empirically, I think the link between exchange rate as well as manufacturing exports, in my view, is not a very strong linkage. Yes, in terms of services exports, there is definitely a very strong linkage. In fact, we are very competitive in the international market. So we find that there is a positive link between exchange rate and service exports. But if you look at the manufacturing exports, it is not a very clear story. Some sectors do very well if there isn't a depreciating exchange rate. But in some of the sectors, the depreciating exchange rate will have an adverse impact. So to have a blanket policy of depreciating exchange rate in my view, is not a very great policy at this juncture. For me, I think what is right now happening is that there is a compression of demand across the sectors, like private sector or corporate, government, except government to some extent. In any case, there is not much demand in the external market where you can push the products. So in that sense, right now I think it's very important for us to, for time being, don't look at the export component, rather you should look at how to revive the domestic demand. So there, what I'm trying to say is that it's very important for the government. There is a textbook kind of a policy where you follow a counter-cyclical measure. So in the context of declining growth, what I suggest is that the government should go for a counter-cyclical measure by relaxing the fiscal deficit target. I mean, I have been talking about this for the past 1 year or more. So when you have a very flexible inflation targeting, why are you having a tight fiscal target? You should have a flexible fiscal target. You know, there are a lot of risks for the fiscal policy, but you have a tight fiscal target. So, and at the same time, the kind of FRBM, the kind of fiscal target that we are achieving is not really consistent with the FRBM suggestions. FRBM says there is a expenditure switching from consumption to capital. We are very comfortable achieving the fiscal deficit target of 3.2%, but we don't know what is the revenue deficit target as per the FRBM Act. So, in a sense, we are very happy that government is following a tight fiscal policy, but we don't see that what is happening to the capital expenditure. The kind of FRBM that we are following, there is a decline in the capital expenditure as a ratio to GDP. That is not what FRBM Act is suggested.
Sure.
So the point I'm trying to say, right now we are actually in a downward slope. So we need to have a counter-cyclical fiscal policy measures immediately.
Okay, fair enough. Let's move on now and go back to a point that Mr. Shankar raised about, how private investment is at an all-time low at this point in time. Professor Panda, what needs to be done to boost private investment?
In India, the public investment has always been, it has played a complementary role to private investment. And at this stage, possibly the government must take a lead in investing more in infrastructure sectors. They are already doing it on the roads, maybe little bit more on railways. And also I'll add that they also should invest more in the social sectors. After all, when we talk of GDP, it is for the welfare of the people, and people must feel the benefit of the GDP growth. So if we can invest a little bit more in the social sectors like health and education, there is a large gap in meeting the needs of the people, and that must be, to some extent at least, government must play a critical role in that. Having told that, I also realize that the education and health, the critical action will come from the states, and the center can possibly play an enabling role, a persuading role, and maybe they can take certain measures where there will be investment, incentive for the states to, for example, fill up the positions available in the education sector or in the health sector.
Sure.
There are many schools, particularly at the primary level, where 5 or 6 standards are taught by only 2 or 3 people. Obviously, without having the right number of teachers, we cannot expect the educational sector to grow.
Right.
And that is also becoming a critical part. Education and health will be the critical drivers of growth if we are looking at from welfare point of view, if we want people to feel the benefits of the growth. So I'll add that apart from the physical infrastructure, social infrastructure also should be looked into, and government can play a major role in putting a complementary role to the private sector.
Okay.
But I'll also, add that the non-performing assets of the banks, that's also possibly playing a major disruptive role in the economy in inducing private investment. And government has already taken certain measures, as well as the RBI now has come up with the insolvency code. So if they move on that and try to solve some of the major defaulters,
You know, I'm going to take the point that you're making forward to
a
Mr.
signaling effect to the private sector can come.
Right, sure. I'm going to take that point forward. You know, 2 or 3 points raised there by Professor Panda. You know, NPAs, we all know that NPAs are a major problem as far as the economy is concerned. A lot has been said about it, so we won't go into the NPAs. But let's talk about social sector expenditure increasing. Do you believe that that's the way to go forward? And also, till that time, as you know, private investment picks up, should government spending continue to increase?
I would urge that we have to look at sectors and see whether we have any policy instruments which will generate demand in the short run as well as medium run for the domestic private sector, which would then be inclined to invest more. And we have to think out of the box and think of instruments which are normally not thought of. So for instance, I have to just give you an example. We are doing very well in solar power. We want to do 100,000 megawatts. Now all of it will be imported from China. Can we do industrial policy measures that we add value addition in India, and if not 80% of the value addition, at least 60% starts taking place in India in 3-4 years? In the IT sector, there was a report a few years back that imports there would exceed the petroleum sector imports. Then government woke up and some measures are now being implemented whose results are being seen. So maybe it's time to look at the big sectors where demand is large and is growing and see what policy instruments we have whereby we can increase value addition in India. In effect, it means that you choose to create competitive advantage rather than to just live off the competitive advantage you already have. Now, this is a bit of a departure from our traditional policy in the post-reform period, where we have felt that it's not for government to try and create competitive advantage in any one sector or the other. So some rethinking and some major sectors which create lots of jobs and where there is a lot of domestic demand, how do we move in that direction? And I would also again like to slightly disagree with my fellow panelists that the exchange rate has a huge impact on the domestic market and how much of the domestic demand is met by imports. Because after all, our market is open, so we can buy goods made in China or chocolates from overseas, etc., etc. So the exchange rate has a big effect there, and historically in the last 50-60 years, depreciation as a part of the IMF World Bank packages has helped.
Sure, sure.
And what I was urging is undoing the real exchange rate appreciation, not intervening in the market, intervening only to see that the distortion or market failure is set right. Because our exchange rate has appreciated not because productivity has gone up.
Sure, fair enough. You know, let me welcome Sandeep Bamzai, Editor-in-Chief of the Financial Chronicle, to the big picture at this point in time. You know, Sandeep Bamzai, as far as the macroeconomic environment is concerned, it seems to be benign at the moment. Are you worried then that growth is still stuttering despite what's happening on the macroeconomic front?
Very clearly, the slowdown is now almost 18 months old, and unfortunately, we've been blindsided by the extent of the slowdown. The fact that we remain a consumption economy is obviously a big positive, but two events more or less back to back seem to have acted against that consumption story. One, obviously, demonetization, which created unprecedented demand destruction, and then of course the goods and services tax and the various imponderables that were associated with it, which has dampened sentiment to some extent as far as consumption is concerned. I think at this particular juncture, given the fact that the slowdown is no longer transient in nature but actually quite acute, the last GDP print substantiates that. If you go back to the last full financial year before the BJP came to power, it was an unprecedented 4.7%. After that, the GDP print was changed, the various anomalies were taken out of the system, new updation was done, and you actually had better GDP numbers. Now I think it is imperative that the government does two things. One, obviously accelerate public spending. Where the funds are going to come from, I mean, I wish that the 9 excise duties which have enabled the government at the center to raise 273,000 crores and change, part of that proceeds could have been used as a stimulus for the economy. I don't know where that cash is deployed. I don't know whether we'll actually get to know where that cash is deployed. And two, I think this rigidity that we show as far as meeting ratings upgrades or meeting the requirements of the ratings agencies so that we actually get an upgrade. History will tell you that in the last 25 years we've only got one upgrade.
Sure.
One. And I think the time has come to tweak the FRBM. The FRBM actually allows, there's a clause which allows you a slippage of 0.5%. I think we should look at more extensive public spending, look at missing the FRBM target, and ensure that this by itself acts as a catalyst for growth.
Right, sure.
And these issues, if they're not reconciled at this precise moment, I think you will find that the GDP print for the full year will be less than, it'll be sub 6%.
Okay, sub 6% is what you're suggesting. A few rating agencies have said 6.7% to 7%. But is that the new normal now, NR Bhanumurthy? 6 to 7% growth. Any which ways you're going to reach that?
Well, I think what you're talking about is the potential output. You know, the kind of investment that we have at the moment, sub 30% or maybe 26 or 27%, given the ICAR of 4%, I think you should be close to 7% is your potential output. So, in the absence of external demand, my guess is that 7% is not a bad growth. It's a very decent growth in that sense. So, I think if somebody is predicting 6.7 to 7, we are close to our normal in a sense where there is no export demand and there is no external demand that's happening.
Okay, fair enough. I've got about 2 minutes left on the program. Let me go to Manoj Panda for right now. You know, as far as long-term measures are concerned, what needs to be done, Professor Panda?
No, first of all, you know, a signaling effect that we are not disrupting the economy too much. At the same time, the government will carry out its intended intention. That balance has to be there. That, you know, in the short run, the disruptions are not too much. There will be some disruptions when you take major reform measures, but do it in a slow and steady way, keeping, say, a 5-year or 7-year target in mind. I do agree with the fellow panelists that a rigid fixed fiscal deficit number is not a desirable thing, particularly in a situation like this, and some flexibility is needed. And in fact, I'll add just one more thing, that if we are having a higher growth on GDP numbers, the rating agency will be possibly happier than a slippage on fiscal deficit by 0.5%.
Okay. Mr. Shankar, close the show for us with your concluding remarks.
In addition to whatever loosening of the fiscal deficit that may be considered, the elbow room there would still be modest. So, we need to see how we could leverage public spending to get more private investment in. So, I think it's maybe a good time to see how we can revive PPPs and bring in PPPs in certain new sectors where we have not attempted it before, like affordable housing, smart cities, etc., etc. Because that, I think, is a space which is there, and there is some precedent available where government has also been able to do some short-term stimulus measures in a very targeted manner.
Indeed. All right. On that note, then I'll have to call it a wrap on this edition of The Big Picture. I'd like to thank my guests, Ajay, Shankar, Manoj, Panda, NR, Bhanumurthy and Sandeep Bamzai for joining me on the program and putting things into perspective for us. That's all the time we have today. See you again next time.